everyone. It's David Darst here to give you a recap of the month of August 2023. As you may know, August and September back-to-back are the two worst months of the year on average since 1928. August traditionally has gone down, the S&P 500 0.7%, and then September 1.1%. There's a lot of reasons for that, but it is what it is. The month of August through late August was down anywhere from 3.5 to 4% this year. So again, though, that number of minus 0.7% is an average. It can be above that, it can be below that. The major reasons for this were some broad feeling and questioning within the investment community about the three pillars that have driven the stock market up for most of this year of 2023. And those three pillars, as you know, and we're going to address those quickly: soft landing in the economy, disinflation on the inflation front, and no more hikes, or maybe at most one more hike by the Federal Reserve. So those were the drivers. You could also add in the whole enthusiasm, excitement, perhaps over-enthusiasm about artificial intelligence, and chat GPT and generative artificial intelligence. I would add in recent months the whole excitement over weight loss drugs. You have one in the United States, you have one in Denmark, of course, and there are others now circling around trying to figure out a way to do this. It's by injection, as you know, to do it by pills. So let's take these things one at a time. The soft landing. The soft landing theory was basically driven by the great economic performance of the U.S. GDP. For the first quarter was plus 2% annualized. Second quarter, 2.4% annualized. And the third quarter, as of late August, by the Atlanta Fed, that's the GDP Now forecasting tool, 5.8%. It had earlier been 5.0%, 5.8%. So you had new jobless claims, still well below 300,000 per week, something like 238,000 as of the third week of August. So the labor markets were tight. Now, on the other hand, there is creeping in some question about whether the soft landing was going to be maybe a little bit harder than people had been anticipating. Number one, the comments by retailers. You've seen many of the big department stores, many of the big sporting goods stores have been indicating in their earnings reports, which came late in the month of August, that the consumer has basically not gone on strike, but has really downshifted their activity. You see a lot more credit card usage and some defaults or delinquencies, I should say, on the credit card usage. The KBW Bank Index, which we follow, you had some of the rating agencies come out, as you know, earlier this year with questionable comments on a number of the regional banks, 17 of the regional banks. But then they came out even with the large money center banks. So the bank index, the KBW Bank Index, through late August was down 21.3%. So that was another part of this pillar that had been eroded or had been shaken a little bit. Lead economic indicators through June down 15 months in a row. And it has been a very good, reliable indicator of recession. Our view is that recession will take place. It will probably be in 2024, and it will be on the mild side. That's where we are right now. Industrial production has been choppy and mixed. You can see one of the big indices, the ISM manufacturing, is below 50, but you've had Philly Fed and New York State Empire Fed, regional manufacturing indexes giving conflicting signals, but choppy, okay, choppy. And finally, as you know, China, with the real estate sector there under pressure, youth unemployment under pressure, okay, China has, the GDP growth has come down. The estimates, and they are a big contributor to global growth, as you know, from around 5%, 4%, and I've seen numbers recently of 3%. So that's pillar number one. Pillar number two is disinflation. The one-year expectations have come down from around 3.8% for the survey of consumer expectations of the New York Fed, 3.8% back in January, to about 3.4% as of July. So you have seen them coming down somewhat. Yet, on the other hand, the Consumer Price Index, which was just recently released for June, you had 3%. You're up to 3.4% for July. And Producer Price Index, plus 0.1%. That's gone to plus 0.8%. So you've seen this disinflation. Again, it has been slightly destabilized here. And finally, the no hikes. Okay, remember the Fed's going to basically stay on hold for longer, and they're going to basically start hiking, cutting, no hikes and cutting maybe towards the end of this year. The Fed rhetoric, and I would point very much to that. You had Nick Timiraos, he's a Wall Street Journal reporter, and he is considered to be a mouthpiece of the Fed. And he's been talking about in some of his recent articles, very large articles, by the way, in the Wall Street Journal, basically talking about the Fed officials, the Federal Open Market Committee members, wondering whether they don't want to cut interest rates too quickly. So you've seen Fed funds futures markets have moved outward. The expectation of interest rate cuts from originally March of 2024 all the way out to May of 2024. So that's one thing. This has put some pressure on the bond market, and those rising yields have in turn put pressure on the stock market. If I had to point one big factor in the month of August, the bond market, you were up above 5% in late August, up above 5%, 5.04%. You've had interest rates up 80 basis points from January, not since January 1st, but the end of January. You were about 421. You're over 5% now, 504 in that neighborhood for the 2-year, up 80 basis points. The 10-year has gone from 354 to about 421 or thereabouts for the 10-year, and that is a very, very high number. That's the highest in 16 years. You got to go back all the way to 2007 to find the 10-year at that level. That has, of course, put upward pressure on mortgage interest rates. And there you have the 30-year fixed-rate mortgage, as reported by the government, at 7.7%, which is the highest since 2000. So that's the highest in 23 years. The minutes of the Fed that were given out from the July meeting, were indicative of this split on that Federal Open Market Committee as to should we keep them higher for longer. So as we begin to enter the last trimester of the year, September, October, November, December, as we begin to enter the last trimester of the year, we are counseling a diversified approach within liquid markets. You could extend out and pick up some further duration and maturity in the fixed income markets. The alternative space, there we still like very, very judicious, selective approach towards private equity, private credit in particular, where you can pick up some yield. In the private equity space, you might want to be thinking about picking up the secondary market sale of partnership interests, and private real estate. There you also want to be very, very opportunistic. With that, we wish everyone a great start to the month of September and look forward to catching up with you very soon.